Time to dig even deeper into the Volcker Rule. Brad Hintz is with us this morning to tell us what it means for bank profits. Brad has spent decades on Wall Street. He's an analyst at Sanford C, Bernstein, a former treasurer at Morgan Stanley, and the former CFO, way back when, of Lehman Brothers. He says Volcker could cut fixed income revenues at U.S. banks by 25%. So, Brad, before we get into the particulars of the Volcker Rule, why don't we start with the names? Who is going to be most affected by the Volcker Rule? The institutions themselves.
Well, that's certainly those with the largest fixed income operations. So a Goldman, a JPM, Morgan Stanley. Those would be the logical players, and of course the winners would be those that are exempt from the Volcker Rule, which would be Jefferies and, at least until recently, MF Global.
Can you walk us through exactly where flow trading ends and prop trading begins? So let's take a plain vanilla corporate bond desk. I'm a client. I need to sell 10 million bonds. How does prop start and flow end?
Well, you've got exactly the issue, which is because there is no such thing as agency business in fixed income, or if there is, it's such a small portion. Then what you're really doing is, if I'm selling you something, I'm taking it out of my inventory. I have the inventory, that's a risk position. If I'm buying something, I'm putting it into inventory, that's a risk position. So fundamentally, inherent in fixed income, it's all risk-taking. So unless you were to say non-client facing business is proprietary trading, that would certainly be a narrow comp. But if I'm making a market, there's risk.
Then we talk about Volcker Rule affecting U.S. banks. Isn't it going to affect clients, the largest institutional clients? If I'm PIMCO, BlackRock, and I need to reduce 10%, if I need to reduce 1% of my positions, who's going to buy my bonds?
And you fit the other one, which is, if you'll notice, the Volcker Rule exempts government trading. Well, why does it exempt government trading? Because we need liquidity in the government market. That's the way to get low interest rates. But if I do it in the corporate bond market, what's going to happen? Bid-offer spreads are going to open up. When PIMCO is selling, the bid is going to be much, much lower. When PIMCO's buying, the bid is going to be on the other side. So the pricing is going to be very, very different here, and it's going to affect liquidity in the marketplace. It's going to affect the ability of a corporate treasurer to raise money.
Is that where you come up with 25%?
Well, it substantially affects credit. It affects all the non-client facing businesses. Now remember, there were non-client facing businesses. Those were going to be gone. We had always assumed that was Volcker. But what was a surprise when the Volcker rules came out was that it prohibited flow trading. And flow trading is the bread and butter of the business.
Brad, I want to play the devil's advocate for just 1 minute here, which is to say, what is to say that this won't be like all of the other rules that have been imposed upon Wall Street, about which Wall Street screamed bloody murder and ultimately just found a way around, or at least the business evolved in a different way? I can't draw a perfect analogy because I don't think one exists, but go back all the way to the Securities Act of 1933 and 34, the refrain we've heard before, and yet Wall Street is still here.
Isn't that what Wall Street does, find loopholes?
Or new ways of doing business.
And I expect that what you're going to get is you've got a negotiation going on here. Why is it under the Volcker rules that I'm allowed to take proprietary risk and government trading?
Just treasuries, right?
Just treasuries.
Not even gilts, not bunds.
There you have it. Gilts or JGBs or bunds. Is there some reason why we want all the U.S. firms no longer primary dealers all around the world? And fundamentally, if I can't take proprietary trading risk, if I can't do that flow trading, then I'm asking our firms to compete against foreign firms with one arm tied behind their back.
But then why are you saying is it good for Jefferies? Like, clearly it's bad for a big U.S. bank, but where do the Jefferies and other boutiques have an advantage?
Well, they have an advantage very much like a Salomon Brothers had an advantage over a much larger firm, the Bankers Trust, if we were to go back into the 1980s, where Salomon Brothers did not have a regulator tightly constraining it. And as a result, Solly was able to dance around, run higher leverage ratios, was able to trade more aggressively, was able to be more successful. Now, I look at this.
But you're not saying Jeffrey can take risk and JP Morgan can't.
Jeffries can take
Okay,
can do is not a bank, and remember, Volcker hits banks.
Because it's part of Dodd-Frank.
That's right.
All right, Brad. Lovely to have you here. We look forward to having you back. As always, Brad Hintz of Sanford C. Bernstein, former treasurer at Morgan Stanley, former CFO at Lehman Brothers, who knows more about how the Volcker Rule is going to hit the bank's bottom lines.